I asked ChatGPT to build a dividend plan to generate $1,000 a month in income. It gave me a full portfolio along with assigning specific sector exposure and even gave me some hints around tax strategy. Remember, neither ChatGPT nor I are financial advisors, so do your own research. Speaking about financial advisors, one of the reasons that I think ChatGPT is a good tool to use here is it has no motives. It's not being forced to sell me a specific stock or ETF because it earns a fee from it. In my opinion, it's the best chance we have at getting unbiased information as we look for the best dividend stocks or ETFs to invest in. Here's how we'll break it down. First, how much money do you need and how long would it take to generate $1,000 per month in dividend income? Second, do we need stocks or ETFs or both, and why? Third, how do we balance between dividend yields and long-term growth of the assets that we own? Fourth, is this a realistic plan or is it just fantasy created by ChatGPT? And finally, I'll provide you with all the prompts that I used to get to the dividend plan to generate $1,000 a month. All right, let's go. So the first question I asked ChatGPT was how much money I need as invested capital to generate $1,000 a month in income. Here's a prompt I used. How much money do I need at different dividend yields to generate $1,000 a month in dividend income? Present that to me in a table. So here's what it gave us. So at a 2% yield, we would need $600,000 to generate $1,000 a month or $12,000 in annual dividend income. At 6%, you will need $200,000, and at 10%, you will need just $120,000 to be able to generate $1,000 a month in dividend income. In most cases, the further you move down the yield curve or yield expectation, the riskier the stocks or ETFs you would need to own to generate that level of dividend income. But at the same time, the lower dividend yields represent safer stocks or ETFs, but require much larger investment capital. So with this information, we're going to work through building a plan that's reasonable for the average person with the help of ChatGPT that balances risk, reward, and income. So the next question I asked ChatGPT was, what's a reasonable risk-adjusted yield target that balances the need for income with growth with moderate risk? So it conducted that analysis for us, and here's what it provided us. It says that the sweet spot is somewhere between 3.5% and 5% in dividend yield. That balances our need for income with some growth at a relatively moderate risk. And then there are a few different asset types that we can own. So dividend growth ETFs like SCHD and VIG, REITs, and utilities like VNQ and XLU, covered call ETFs like JEPI and QILD. Those are relatively higher yield ETFs. They generate high income but less growth and higher complexity. And then preferred stocks, which allows you access to non-common shares of a business. And those are relatively high yield. They're usually less liquid, so you can't just buy and sell them. And typically accessibility to these types of preferred stock profiles are often not available to people like you or I. They're often available to people like Warren Buffett and other well-connected investors. So based on that, the options that we have are dividend growth ETFs, REITs and utilities, and covered call ETFs. And as we move down the scale here, they get a little bit more complex and slightly more risky. So for the profile that we just talked about, where you have moderate risk, decent dividend income, the sweet spot is between 3.5% and 5%. And to get there, you would blend a 60% core dividend growth portfolio with 30% high yield REITs or utilities and 10% cover calls ETFs. So the most risky is the least concentrated in our portfolio. So we're going to build 3 dividend portfolios for 3 profiles of investor: the high capital, low risk investor, the moderate capital, moderate risk investor, and the low capital, high risk investor, all targeting our $1,000 a month dividend yield goal. So let's start with the high capital, low yield investor. Let's see what mix ChatGPT suggests, and specifically what dividend ETFs or stocks it chooses. So here's the portfolio that ChatGPT suggests for a low risk, high invested capital portfolio to reach our monthly goal of $1,000 a month with a growth potential that keeps up with inflation and diversification across multiple different sectors and income sources. Here's the portfolio plan. So for the core dividend ETFs, 50% of the allocation, and the ETFs here, it suggests are SCHD and VIG. The estimated yield there is 3.2%. The REITs ETF, 20% of the portfolio, VNQ and FREL for 4.2 percentage points. REITs are real estate investment trusts. So think of this like you owning an income producing property, and the rent minus expenses collected on that property is what your yield is. Then you've got the covered call ETFs, so 15% of the portfolio, a little bit riskier, and the suggested ETFs are JEPI and XYLD, and the yield on that is 7.5%. And then you've got your utilities and staples, 10% 10%, XLU and XLP, the yield on that is 3.5%. And then you keep some cash on the books. So money market or short-term bonds, and the rate on that roughly 4.5%. The weighted yield calculation on that portfolio is 4.15%. So in order to generate $12,000 a year at a 4.15% yield, the calculation is $12,000 divided by 0.0415, and your investment amount would be $289,157. So to generate $12,000 a year in a relatively low risk way, you would have to invest about $290,000 to do that. So not everyone has $290,000 just sitting around to invest in a low risk way. So for those that fit that bill, what you need to do is increase your risk appetite moderately in order to be able to invest less capital with slightly higher volatility in order to generate the same returns, or $12,000 in a year or $1,000 a month. So let's ask ChatGPT to do that for us as well and tell us what we would have to invest in order to generate those returns. So since I just completed the analysis for a low risk portfolio, I can just continue the conversation with ChatGPT and I can say, can you please run this same analysis for a moderate risk portfolio? Assume that I don't have $290,000 to invest to generate $12,000 in income. Give me the blend as well as specific ETFs, stocks, and other instruments to generate the income I want. Let's see what it provides here. All right, so it builds me a strategy here, and let's see what it looks like. So it still has a dividend growth core, but instead of at 50% in the low risk scenario, it's now down to 30% because we need to invest more in slightly more risky yield opportunities. So our covered call ETF is up to 25%, and that will generate roughly 9% yield. REITs and BDCs are now at 15%, and to the extent that we have access to these preferred stocks or bond ETFs, we would generate 5.5% from those. I really should ask it not to include these because not everyone has access to these. We can buy bonds and bond ETFs, but we don't always have access to the preferreds. And check this out. It does the calculation again for us. So 30% for the dividend growth core at 3.2%, which is the yield, 20% times the 6.5%, the yield for the high yield blue chips, and so on and so forth to get a total yield of 6%. So how much capital would we need to generate 6% yield? $200,000. That's $90,000 less than the low risk plan, but it's got some trade-offs that we should talk about. But first, let's look at the portfolio. So this is a very diversified portfolio. So if you're a dividend investor, I'm sure you've heard of the SCHD. The SCHD is Charles Schwab's dividend ETF and its yield, and it gets the bulk of the allocation. And then you have things like MO, which is Outshare stock. It's a high yield stock, generates roughly 9.2%, 10% of the allocation there. JEPI and QYLD, these are covered call ETFs at 7.5% and 12% respectively at 10% of the portfolio. And you've got a preferred stock ETF here. So it's actually available to us. I wasn't aware of that until I started making this video. So that's pretty cool. So here are the key trade-offs of pursuing this plan. Yes, you get the lower capital needed, so only $200,000 versus $290,000 to generate $12,000 a year in income, but you subject yourself to more price volatility. The price volatility can be seen in many of these stocks, like Home Depot moves up and down quite a bit. Johnson & Johnson is a defensive stock, but it could move up and down with the market as well. The covered call ETFs also can move up or down quite a bit, trading at discounts to their NAV values or premium to their NAV value. So that's something to keep in mind. So let's ask it to create a portfolio if I only had $100,000 to invest. So we'll ask ChatGPT, what if I only had $100,000 to invest? What can you please build that portfolio with the specific names it should hold? So here's what it calculated for us. So this is the max income portfolio at $100,000 invested. And you can see we have a lot of covered call ETFs, the equity premium ETFs, the BDCs or business development corporations like Main Street, options ETFs, floating rate ETFs. And you can see the yields on these are pretty high. But with these high yields come higher risk. Like I mentioned, as we move up the yield curve, the more risky the holdings become. So what are some of the risks that we face here? So first is limited upside. The more covered call ETFs that we include in our portfolio, the more we cap the upside. We don't get to benefit as much from price appreciation of those stocks. The higher the yield, the higher the likelihood that dividend cuts are possible as well. So the income is not guaranteed, and rebalancing might be needed over time for each of these ETFs. We haven't talked about the tax piece of this yet, but several of these ETFs would not be qualified dividends, which means that they'll be taxed at ordinary ordinary income. There's a specific criteria for something to be called a qualified dividend, and not all of these strategies fit that. So even though you might be getting a high yield upfront, you might be losing some of it to taxes. So this mix works. You could do it with $100,000, but be aware of the risk that you're taking on by utilizing this portfolio. So the next question we might want to ask is, for these three portfolios, what are the tax implications that each one is exposed to? So I asked ChatGPT, can you explain the tax implications that each of these scenarios is exposed to? What are the pros and cons of each, and which is the most and least tax advantaged? All right, this is really critical here. Now remember that ChatGPT or I are not financial advisors, but this is great information for us to go back and use to analyze our portfolios to determine how taxes impact what we own. So here you see it. For these tickers, the covered call ETFs, they are mostly taxed as ordinary income. So if you remember, these tickers were high yield, but some of that yield is going to go back in taxes, mainly because they're not qualified dividends. So they're typically taxed at a higher rate, except they are in your IRA. So that's something to keep a note of. Similar to the business development corporations. So they are taxed at ordinary income as well. The yields are high, but they are immediately taxed as you earn the dividends. The real estate investment trusts are the same as well. The closed-end funds, some are taxed at ordinary income and some are taxed at qualified dividends. So you need to watch out for that. The most tax advantaged group is this group right here. So you can see individual stocks like Home Depot, Johnson & Johnson, VIG is an ETF comprised of stocks, and the SCHD. Those are qualified dividends and are taxed between 15 and 20%. They're very tax efficient. You can own them in multiple different kinds of accounts, but the downside is that the yields are lower. So it's a balance between yield and taxes. And so you need to do your homework on what strategy you're choosing to pursue here. If you're in the lower income tax bracket, it might make sense to go for the high yield opportunities because you're in the lower income tax bracket anyway. But if you're in the high income tax bracket, it might make sense to go with the qualified dividend stocks and ETFs. But everyone's situation is different and you need to do your own analysis to determine what's best for you. So here's a summary of what we just talked about. Here we have a ranking based on tax efficiency. So you can see the qualified dividends are the most tax advantaged. And then you've got the covered call ETFs, taxed at ordinary income, REITs, ordinary income, and then the BDCs are fully taxable at ordinary income. And then what account should they be in depending on what you pick? So in a non-retirement taxable account, you might want to do the stocks and ETFs because those are qualified dividends and are taxed at a lower rate. Essentially everything else is either going to fit in your IRA accounts, either your Roth IRA or your traditional IRA, because they're not taxed up until the point that you are withdrawing from those accounts when you're retired. So what did you think of this analysis by ChatGPT? I found it to be a very effective assistant in building the right portfolios for different situations. Which of these ETFs do you own? Why don't you comment below and let me know? Are there any other strategies that you would employ in trying to generate $1,000 in income per month? Why don't you comment below and let me know as well? If you enjoyed this video, you will like this other video where I talk about how I use ChatGPT to pick great stocks for my portfolio, or this video where I talk about what stocks ChatGPT suggests to own during a recession. Please like and subscribe to the video. I look forward to seeing you in the next one.